Hello, everybody. Welcome to Jolene's Market Update today. We're delighted to introduce Jolene Moore as our distinguished speaker for today for the March Mortgage and Market Insights. I can't believe it's finally going to be some great weather. Hope you guys enjoy it. Jolene is a celebrated expert in mortgage finance, renowned for her deep market knowledge and meticulous attention to detail. As a leading authority in the field, she is recognized nationally as a top producing lender. Jolene currently holds the position of branch manager and senior home loan consultant at Cross Country Mortgage. She is also a sought after trainer with us. Jolene offers a variety of educational programs, including mortgage training sessions in her Fairfax office, business development seminars, and other courses tailored for real estate professionals. And of course, you can always go to cindybishopworldwide.com to upcoming events, or you can always call them depending on what they're doing. They do lots of good things for agents. And anything Jillian did pretty much can elevate your business. So keep that in mind. And I think most of you know that. So with no further ado, Jolene, take it away.
Thanks, Cindy. Hello, everyone. Happy Tuesday. Can't believe it's already March 4th, but we're here to do an update for you on the market. So we always start out with kind of interest rates and where the market's been going. So I thought I'd share with you guys, here's a chart, and I'm just going to actually bring the website over that I pulled it from. This is a organization that I belong to that kind of just tracks the trajectory of the bond market, which therefore impacts what interest rates are doing. So you can see that we kind of, this meaning the dip down here means that this was the high that we of interest rates that we hit. So we were probably by mid-January is where has been our highest point in interest rates so far this year. And then you can see that we started to kind of flat for a while, and then we started to move up, and then we dipped again a little bit in mid-February. And then now again, we've been on a trajectory of improvement. Now, it looks like this chart is can be a little bit hard to know what that means in interest rate wise, but I would say probably in mid-January or mid-February, we were probably in the high sevens here. We're probably in the mid to low sevens here. And now we're in the kind of mid to high sixes, as I'd say, where interest rates are right now. Just depends on the scenario, interest rate, credit score, loan to value, whether or not you're a first time home buyer, all of that. But VA loans can be in the low sixes, government loans. So obviously going in the right direction. The job report comes out, or the job numbers, job creations comes out on Friday. That has been a big market mover over the past several months, because that's kind of what started projecting, shooting us back in September of last year. So right now, there's an expectation that the job numbers, the amount of jobs created, are going to come in lower than expectations. And if that's the case, we could continue to see rate improvement. But if it does not, if it either shows inflation concerns or it shows job creations more, greater than what's expected, then we could see dips. And you can see kind of these lines here. These are always the lines that are kind of like what they call a cushion of support. And so basically what, our update today was that, we could see if we start to, a downward trend, there's a decent amount that we could drop to before we get a level of support. You can see here this running number. This is the 30-year 6%. This is the mortgage-backed securities. That's what you can see in the green. Means we're slightly positive today. The 10-year treasury is slightly positive. So when we see this shift to red, then that's when you see the red here. So good news is we're doing well right now. So it's helping clients, help with affordability. Obviously, there's been lots of different things happening in our world that will have impact on this. So we will keep an eye, and of course, always update you guys on where things move from here. In regards to just a little bit of market news, the Atlanta Fed reduced their Q1 GDP, which means that they went from, originally they were thinking there was going to be a growth in the gross national product, and now it's shifted to a negative, and they're thinking that we're going to be down 2.8%. So there are experts in our industry that believe, if things continue on this path and if the Q1 numbers do come out in a negative, and obviously if we see that 2 quarters in a row, then that's when we can start to point potentially to a recession. Recession would push the Feds to lower their rate, which could help us as well. So we will see, and of course, keep an eye on that as well. Tariffs have been announced, as you guys, I'm sure, have heard. And it looks like the tariff on China went from 10% to 20%. So obviously tariffs can be inflationary, and inflation, mortgage rates do not like inflation. But one of the things that has happened since September that can help with offsetting some of the tariffs that's being put into place is the US dollar has risen 6% since September. So, obviously our cost of goods are still going to rise, but that's going to help offset it a little bit. The other thing I wanted to kind of touch on is I met with a client earlier this week. There's looking to be a first-time home buyer. They were potentially going to rent. They have a dog. They made an offer on a listing for a rental. I think it was listed at 3,300. They offered 3,500. I think they doubled the security deposit. They offered, it was just like crazy about what they were offering for that rental property, and they didn't get it. So now they want to explore the purchase market instead. We actually just competed on an offer as well and escalated and didn't win that one yet either. But I'm just curious if anyone else has had experience with the rent market and what they have seen. Because I just like to know, like, for my own information and be able to help educate clients what you guys are seeing in the rental market. So anyone have any information you can share with me on their experience with rentals and share with everyone else? And like Leslie said, you can unmute yourself, would love that, or you can put it in the chat, whatever it might be. But are you seeing a similar situation where you see people having to compete for rentals as we're seeing in our purchase market as well? No one has any experience. All right. If you guys think of anything, let me know. Would love to hear from you. The other thing that I think is interesting, I was just talking to a colleague of mine, is, obviously you guys see in our market, the majority of our contracts that I'm experiencing are competitive, are waiving escalation, waiving contingencies, escalating, things like that. A colleague of mine was talking to someone in Tennessee, I think it was Memphis, and they were like, I've never seen a non-contingent offer. So it is very interesting how different our market is compared to the rest of the country at times. So just keep that in mind when you have clients coming to this market. That obviously what they are experiencing in other locations is going to be different than what they may experience here. So we have to help educate them, as I'm sure you do. But I thought that information could be helpful for you as you're talking to others that are moving to the area. All right, CoreLogic is also predicting right now that the values of homes are going to rise about 3.6% in home value in 2025. They had, I think, estimated like 4.1, and they reduced it a little bit. Most experts are saying around 4%. So again, like when I was talking to that first-time home buyer, when you think about inflation for rental properties, they're obviously going to have their inflation for their rental payment, to the landlord. But think about what they're losing as well by not buying a home and having appreciation, on average 4%. I think in depending on the area of where you purchased in our market, last year, we were between 4 to 7% on average of what our housing prices increase. So that's obviously a lot of wealth and equity that they're losing out on by continuing to rent. So again, it's up to us to educate everyone and help them understand what those numbers look like. So for January, you can see here in Northern Virginia, our sales increased at 8%, and the average sales price in January was up 10%. So again, I know that's hard with affordability, but it also have to help them understand the flip side of that is that's creating wealth for them as well for the future. Prince William was the only area that actually of the three that I looked at showed decreasing. So the houses sold was down 13%, new listings decreased 6%, and the house price decreased at 1%, the median sales price. Dulles sales were up 17%, new listings up 12, and then again, the median price was still up 4%. So you can see in our market, for the most part, we range between 4 to 10% on what we increased just in January, which as we know is, we start to pick up and things start to take off a little bit in January, but, still typically a slower month for us in our area. All right, so some lending information. HELOCs. I get a lot of questions. People always asking me if I do offer HELOCs. I do. So we do provide home equity lines of credit for buyers that are looking to, pull equity from their home, either for the purpose of, debt consolidation, renovations, things like that, or if they want to keep their current home, be able to draw from the equity in their current home and be able to use that towards the down payment. So we're happy to talk through those scenarios with clients so that we can help them understand what the best options are for them. And in regards that, we also have a buy now, sell later program. And the program allows you to put as little as 10% down. And basically the major benefit of this program is that it allows you to carry the current mortgage where we don't have to carry it, we don't have to count the current payment. So if they own a property right now and they want to sell it after, but they don't qualify carrying that payment with their income, we have the buy now, sell later that allows them to not have to count that property. We have to have a listing agreement showing that they're going to be listing the property within 90 days. And if we do, then that allows us to not have to count that payment and allow them to qualify to buy. Now it is what we call a portfolio product. So it's a cross-country product, which means the rates are going to be slightly higher. So it's, there's obviously, caveats to it. So that creates the risk. So associated with it. So in turn, we are going to have a little bit of a higher interest rate. But, they can look to refinance down the road. They can look to apply money towards the loan later and recast. So there's ways for us to help them navigate through that. But it's a great option for clients that aren't able to qualify without selling first. 5% down renovation and construction loans. We just closed one last week where they were buying a $650,000 house. They were doing $300,000 in renovations. They were able to put 5% down. Now, I will tell you, the closing costs for renovation loans are higher. So I would say they need to anticipate, depending on what state they're purchasing in, they need to probably have 8 to 10% total for cash to close for down payment and closing costs. We can go up to a loan amount of 1.209 million for them to be able to take advantage of that program. Bank statement program. This is something else that has been really helpful to a lot of clients for us recently. Self-employed borrowers only. If you're self-employed, we can do it either over 12 or 24 months. Like we have a client right now who has been self-employed for several years, but when we looked at his bank statements, there was a decrease from if we looked at 24 months, but if we looked at 12 months, there was not a decrease in income. So then we could use the income and allow him to qualify to purchase a home. So we have to get all of their bank statements and plug in those numbers to figure out exactly what that qualification would look like. Again, this is a portfolio product. So this is something that's going to have a little bit of a higher interest rate as well, but it's very reasonable. It's a really good product. Liz Hunt just asked if the buy now, save later is at a bridge loan. No, it's a 30-year fixed traditional mortgage. So it's a loan that stays, for as long as you keep it. It's just a product that we have that's allows us to not have to count the current payment on the current mortgage as long as we show that it's going to be listed within the 90-day period. So not a bridge and not additional closing costs either, like a bridge would have. But thank you for the question, Liz. I really appreciate it. Any other questions? Please unmute yourself, throw them out there. I want to hear from you guys. All right, appraisals, just so again, I've mentioned this so many times, but it continues to hold true is that fast closings have proven to be very valuable in this market. So we have closed loans in 8 days, 11, 12, 14, whatever it takes. We also can do appraisals very fast as well. We can get a rush appraisal done in 1, 2, 3 days. What's additional $150 fees, what most appraisers charge to do that. I will also say, for the most part, most of our appraisals we've not had any issues, knock on wood, with low appraisals. We've actually, several of the appraisals have actually come in over the sales price. And several that the agents and the clients were worried and expecting it to come in low did not. So far, things are going very well with appraisals on our end. Buyer's broker
Hi,
agreement.
this is Lynn. I have a
Yes.
question regarding you were talking about people that own their own business, pretty much self-employed. You talked about the bank statements, but what do you look at? Are you also looking at their tax returns as well? And
No.
what if they, yeah, if you were looking at the tax return, I was going to ask you about if they took a loss, 1 year or what have you. How do you look at that? But
Yeah, we're not looking at the tax returns. We're looking at the bank statements and looking at the income, the deposits that were made into the bank statement. And then there's different methods that we have, without going into great detail, but there's different methodologies that we use to figure out what income we can use from those deposits. Leslie said my mic just changed, sorry. I don't know why. But anyway, so that we then figure out which deposits we can use. And then we either have to find out from their their accountant, what is their expense ratio for their business. So that's something the accountant would help them figure out what that expense ratio is. Or there's another method where we don't use that. And again, without going into great details, it tells us exactly what income we can use. So that's why we really have to get all the information from the borrower before we can tell them exactly what income we'll be able to use and then what that would allow them to qualify for.
okay, thank you.
You're welcome. Thank you again for the question. All right, buyer's broker agreement. Just again, if you guys haven't already been told or heard, lenders, when you guys do submit a contract to lenders, the ratified contract, we do need the buyer's broker agreement along with that. We are required to disclose on the buyer's disclosures if they are paying any of the commission that is due to you. So if the seller, if the buyer's supposed to pay you 3% and the seller's agreed to pay 2.5% and the buyers are paying you 0.5%, we have to disclose the 0.5% on the closed loan disclosures that we send out to the buyer. So we do need the buyer's broker agreement anytime that we receive the ratified contract. So if we don't receive it, of course, we'll reach out. But again, that's something you guys want to keep in mind that you need to provide that whenever that occurs. And then the other thing is there's always new products coming out. And for the most part, most time with a jumbo loan, anything that's considered jumbo, which is above that 1.2 million loan amount, you're going to have 20% down. Sometimes we'd be able to do 15%. We now have a 10% down option, which is pretty amazing, up to 3 million. So if you have some high-end clients that have the income to qualify, but just don't have the assets, this would be a great product that we could look at for them to do, up to 3 million with 10% down. All right. Anyone else have any questions on any of these programs? Okay. We already talked about
Also,
closed loans. Yep.
quick
Go ahead.
thing, any of these programs we have flyers for, so if you guys want me to send that over to you, we can co-brand them. That way you can send them out to your clients, and then that way they kind of have that information available to them.
Awesome. Thank you, Leslie. All right, so talked about quick closes, bridge loans. You know, Liz asked about bridge loans. We do bridge loans, which like I said, is separate from the other products we've talked about. You know, I will tell you the majority of the time I try to recommend against a bridge loan because it is an expensive option. You know, if clients have the time, I would definitely suggest a home equity line of credit. It's a much cheaper option for them. Payment wise, cost, all, you know, pretty much everything. Obviously, if that's our last, you know, last case scenario, that's something we do have available to offer. Government employee clients, you know, obviously we've seen a lot of changes, and you know, I mentioned last time I have a client that just closed last week. She's a government employee, had bought a house about 80 miles out. And now has to come into the office. So they bought a 1-bedroom condo. Her and her husband are both government employees, and they're now going to live in that condo during the week and go to their other home on the weekends. Of course, not everyone can afford to do that. But if you have clients, you know, that are government employees, you know, I definitely touch base with them. I have another one that we had pre-approved, owns currently here in Virginia, was working remotely, now has to report into Maryland. So they're going to sell their house in Virginia and look at buying a home in Maryland. So, you know, obviously we know a lot of people in our market is impacted by this. So definitely, you know, put out social media, let them know that you know, can help them and educate them and understand what their options are. And if you know that they work for the government, you know, reach out to them and figure out what their situation is. I have other clients who are with the government who did not have an impact. So I know it's from agency to agency. So it really depends on where they're working, and whether or not this is impacting them. I think also what level they are at and whether or not they had already been going into the office. Fixed second trust, that's something else that we offer. I've closed a couple of those recently, and those actually have lower rates than the home equity lines of credit. You know, it's a fixed payment, a fixed interest rate. So the payment can be slightly higher, but it can actually be a lower interest rate. So we just did some debt consolidation for a client. I think she saved probably like $600 by going to this from the credit cards and the car loans that she had. So again, this is all about helping your clients and helping them put them into a better financial situation. So if you're having conversations with clients and they're struggling with debt, you know, this is something that potentially could help them. Renting current home, you know.
Jolene, what do we say to people that are hesitant about losing like their low mortgage rate, but they have all these high credit card rates and all that kind of stuff?
Yeah, I mean, you know, we've definitely refinanced people that have low interest rates, but have high amounts of credit card debt. And as you guys know, the interest rates on credit cards are extremely high, you know, in the 20s, mid 20s. And so, you know, again, it's worth looking at to see what is the blended rate. You know, what are you paying on the other debt that you have? What are the interest rates? What are the monthly payments versus the mortgage that you have, and then what the current mortgage is. And as we, you know, continue to improve in interest rates, that is going to be, you know, close that gap more and more for clients. So it's definitely something worth looking at for them to help them understand, you know, does it make sense to keep your, you know, 2.5% interest rate, but you have, you know, quite a bit of debt at 27%? It may not, or it may, and it may make more sense to go with the second trust. So those are the things that we'd help clients, you know, talk through. Renting their current loan or current home, I'm sorry. You know, we definitely have a lot of clients that want to keep their current home because of the low rates we just talked about. So we look at what those scenarios look like. Are they able to, you know, rent their property and be able to rent it in time for us to be able to have that rent to offset the current mortgage payment prior to closing on a new house? So again, these are things that we talk with when we look at the pre-approval and help them figure out what options we have to help them get where they want to be for qualification purposes. Something you know, I've been doing this for over 20 years, and is something I learned in the past couple of weeks. And so I wanted to share it with you all. So I had a client that came to me that owned a property as an LLC with, let's say I think it was 8 other partners, and they each owned like 11, 12% of the property. And so nobody had a majority ownership. One of the partners wanted to buy out the other partners. And what I found out was a Fannie Mae and Freddie Mac guideline is that this client would have to be a primary owner, or majority owner, I should say, meaning he has to own at least 51% of that property in order for us to do it, because it was bought cash, so there was no mortgage on the loan. So in order for us to do a cash out refinance so that he could then pay off those partners, he had to be a majority owner in order to do that. I did not know that, so that was definitely a learning experience for me. And so we did end up finding a product for him. It was a non-QM, non-qualified mortgage, not a Fannie Mae, Freddie Mac product that allowed us to do that. But you know, it's funny because everyone assumes that we'll be able to do what they want us to do. And unfortunately, we can, but it's not always at the price they want us to do it. You know, meaning like he wanted a really low rate. And of course, we'd love to offer that. But because of his situation, you know, it was unique and it didn't fit within the Fannie and Freddie guidelines. So if you have situations like that, we are always happy to talk through it to help them figure out what their options are. Like I had another client come to me that was working with a bank in Kansas, and she was building a house here in our area. And I'm actually from Kansas, so it's kind of ironic, but they they did a construction loan for her. She now has to refinance it into a final loan. They don't do VA loans. They said, no, we can't do a VA loan and make that your final loan. Well, we can, right? And so she thought that was just the way it was, that you couldn't do it. The title company referred her to me. I started talking to her, and now we're closing her on a VA loan and refinancing her out of that construction loan. So always, you know, interesting information, and we will always do our due diligence to find out what we can and cannot do. The other unique situation we have as a client right now is buying multiple properties or multiple lots together, right? This happened, of course, last week while I was on vacation. So Leslie and Yenny on my team were you know, trying to figure out what the options were there. And so we are buying 2 lots together. And they are deeded separately, but because one is non-buildable, we are able to do it together and do the contract for both lots as together, because only one has a dwelling. So again, that means, you know, they talked to our underwriters, did everything they needed to do to figure out what are our options and how are we able to make this work. Christine says, doesn't look like you offer reverse mortgages. Actually, we do offer reverse mortgages. We have a specific department that handles reverse mortgages. So I don't talk about them a lot just because it's not something that I do personally, but we do offer them within the company, and I can refer you to somebody if you do have them. My grandmother had a reverse mortgage, and it actually worked very well for her. She, you know, did not make a payment. As you guys know, you don't make a payment during that time frame. When she came to move out of that property and needed to go into, you know, assisted living, she then essentially almost owed as much as what the house was worth at that time. And so rather than my family, you know, listing it, selling it, and having to come up with money to pay commission and things like that, my mom decided to do a deed in lieu and gave the property back to the mortgage company. So, you know, obviously it eats into equity, you know, that your family could, you know, inherit from that property, but it also meant she didn't have a mortgage payment during that time that she lived in that property. So there are definitely pros and cons to it. And if it's something you guys are interested in, I can refer you to our expert here who can help you walk you through that. Employee down payment assistance. This is another employer, I should say. This is another situation we have right now where we have a client who is getting a down payment assistance, a down payment from her employer. It's very unique, I know, but just so you know that this is acceptable. The employer is providing a large amount towards the down payment. It's going to be a forgivable loan. So it's listed as a second lien against the property. So it has to be calculated in the debt to income or the loan to value. So we have to know about it from the beginning because it does impact interest rates and all of that and what they can qualify for. But it is allowable, and especially in this situation, because she's putting a lot down beyond that money she's getting from the employer. So some little tips for you guys to know about. And again, if you're like me, I like to have little tidbits of information like this. So when I'm talking to people, I can, you know, it'll help me create little stories, create opportunities to have conversations that can lead to more opportunities for you guys to delve into somebody's situation and help them. Anyone else have any specific questions or anything relative to this information that we shared today? All right. Well, I appreciate those that did ask the questions. Thank you very much. Here's all my contact information. If you guys aren't following us already, Jolene Moore Team on Instagram, and we put a lot of videos out, a lot of information. We do weekly videos that hopefully you guys are getting as well. If you're not, let us know. And if we're always here to help. So if you need anything or have any questions, please use us as a resource. And I hope you guys have a great rest of the Tuesday.
Thanks, Jolene. You guys have
Thank
a great
you.
day.
All right. Bye-bye.